Good day, everybody. It's so great to see so many names that I recognize on the webinar today. And it's been so great to see so many of you back in November at the regional summits, as well as in the fall conference during September. Now, I have good news and bad news today. The bad news is for those of you that know me and have spoke with me before, you can probably tell that I've lost my voice. The good news is that you don't have to listen to me for this whole webinar, because I have my colleague Jennifer Jenkins, who runs actually our tax-exempt division, going to be filling in for me today and presenting. But before I turn it over to her, I did want to just reiterate why I think it's so important to have focus in this space. If you were at one of the fall summits back in November, part of the roundtable discussions, you heard me talk about tax-exempt markets and the need for you as an advisor to help these entities. You know, I use the example of a Head Start group that works with low-income individuals in Los Angeles. They reached out to me and said, Kara, we have a 403B plan we're not happy with and we want to change. And I thought, well, that's weird because we don't work directly with plan sponsors. We only go through advisors like yourself. But I started doing research on the 5,500, the 990, met with them just to try to figure out what was going on, because a lot of things didn't add up. And they said, Kara, we have this 403B, nobody's participating, we want to change that. And so I started asking them questions. And one of the questions, you know, I asked the CFO, I said, well, what are you paying for this? And she said, we're not paying anything. And I thought, well, okay, maybe you're not writing a check, but you're paying something. And then I said, you know, what about your advisor? Have you been talking to your advisor about this plan? This was a $10 million plan. The advisor is getting 25 basis points. And the CFO and director looked at each other and said, we haven't seen our current advisor in 2 to 3 years. And I think what pained me the most, though, was that of that $10 million, 70% of it over the past 9-10 years sat in a money market account making less than 1%. You see, this was not a 403B plan. It was actually a 401A money purchase plan. They were giving all their employees 8%, so they were doing a great thing. But then it sat in a money market account making less than 1%. So long story short is we got an advisor that we know that works very hands-on with participants involved in the plan. He got hired on the plan. They eventually moved to OneAmerica. But there are so many examples and situations out there that not-for-profits need help from you, the advisor, that today Jennifer is going to share with you kind of how this all came about, the different types of entities and some ideas around it, how you can work in this space, as well as prospecting. Now, if, like Leah mentioned, if you have questions, please put them in the chat or actually the Q&A, and I'll be monitoring that. And I'll jump in, you know, if you have questions, or I'll answer them. And just to make sure that the Q&A is working, you know, we know this time of the year, most everybody loves football. And so I'd love to see in the Q&A, who's your team? Who's your NFL team? If you don't have an NFL team, who's your college team? And if you don't watch football, what do you like to do when everybody else is watching football? So I'd love to see some answers coming in on the Q&A in terms of who your favorite team is. So while you're doing that, I'm going to turn it over to Jennifer Jenkins, who's been with OneAmerica for over, I believe, 20 years, working in the tax-exempt space. She's an expert in that space. And Jennifer, thank you so much for filling in today, and the floor is yours.
Thanks, Kara. Yeah, Kara mentioned over 20 years. So this year I had my 23rd anniversary, and it was one of those eye-opening moments because I also turned 46. And so I had that moment where I realized half of my life's been with OneAmerica. So like me, a lot of these plans are old. So what happened in the marketplace? What makes this a good opportunity today? So 403Bs came into the marketplace in 1958. So they preceded 401k plans by 20 years, so 1958. And the regulations that surrounded 403B plans, the rules hardly changed all the way up until January of 2009. And the IRS said, we need to make 403B plans a whole lot more like 401k plans. That benefits the participants, that benefits the plan sponsors, and that really makes it a lot easier for you as the advisor to service those plans, to not have the plans be so different. So when that came into place, you would think now that we're about to head into 2022, 13 years later, they would be all up to speed, all the plans would be in line, all the plan sponsors would have updated their plan documents and be operating it appropriately, but that just isn't the case. About 85% of the plans that we take over have some type of operational deficiency or something like Kara mentioned, where they're just not maximizing their plan, whether it's just employer contributions, whether they've got an outdated, expensive contract, whether they've misunderstood the definition of compensation, and so they're not allowing someone to defer off of bonuses. There's just all kinds of things that these plan sponsors aren't operating correctly, which is really good for you as an advisor because you can walk in with a deeper conversation and be much more consultative. Kara also mentioned that a lot of these plans are underserved. So here you had that Head Start organization that didn't have an advisor that was present, but I want to draw you to the bottom left-hand side of the screen that says 45% of these plans don't have an advisor at all. So you take the 45% that don't have an advisor at all, you add it to the 25% that are on there but not responsive, and you've got a big swath of opportunity where you can walk in and rather than totally displacing an incumbent and involved advisor that you find more commonly on the for-profit side, you've got an opportunity to really showcase your abilities to improve their plan. So Kara mentioned that, no advisor was present. We ran into another opportunity with a Colorado municipality. So an advisor in California called us up one day and said, we're going to go meet with a municipality in Colorado. Advisor, California, opportunity, rural town in Colorado. Again, about an $8 million plan. They get over and meet with the client. The client signs a broker of record letter that same day. They hadn't seen their advisor in, I want to say 5 or 6 years. Their plan was completely out of whack in terms of the pricing on it, in terms of plan design. And so that advisor, think about that in the for-profit world, you wouldn't be able to flip a plan over that quickly, and you're not likely to find an opportunity where someone hasn't been out there for 5 or 6 years very easily. The other thing to keep in mind is this is a big market. A lot of people aren't aware, but there's over 3.1 trillion assets in these plans. And that's really about a third the size of the for-profit market. So a big market to data mine. And what do we see in there? Well, we're seeing that number, that 45% each year that don't have an advisor, each year that number gets smaller. And we hope that we're part of that process because we fully believe that every plan should have an advisor, should have somebody who's an independent advocate for them. So we like to see that number go down. We want to see more plans engage with advisors because we think it's better for the plan sponsor and the participants. An interesting study was done. All these plan sponsors don't have advisors, but when polled, 85% of them said they wish they were working with an advisor. So there is a big gap for you there. The other thing that we see is you're still going to find plans out there that have multiple record keepers. So the employer is sending money to more than one vendor, but that is rapidly consolidating down. And really the only place that you see with any consistency, multiple providers is education, both in that K-12 market and also some in that higher ed. But even that started shrinking after, I'm sure we're all familiar with those Schlichter lawsuits where certain record keepers were being sued and the plan sponsors were being sued really for excessive fees. So we're seeing a lot of that consolidation where plan sponsors can improve the experience for the employees. So they're getting consistent education as well as take advantage of all of the assets and get that pricing down. So we see that. We also see an update in plan design. What do I mean by modernizing the plan design? Well, we have a lot of very benevolent plan sponsors in this marketplace that give very, very generous employer contributions. Kara mentioned that Head Start gave 8%, and that's not unheard of. But some of them are modernizing their plan design, taking down that employer contribution and using some of that towards a generous match to get employees involved in their own saving. So there's lots of types of plans out there, and all these are the different tax codes, but who can sponsor what, and why would somebody sponsor one type of plan over another type of plan? Well, first, the 401k plan, it can be available to any for-profit organization. It can be available to any nonprofit organization, so any subsection of 501c. And we're all pretty familiar with 501c3 from the charitable contributions that we make, but there's about 25 other subsections of 501c. So think of your federal credit unions. Those are 501c organizations, or associations, things like cemeteries. They all fall under that 501c umbrella. They're going to sponsor a 401k primarily, unless they are a 501c3. So if you look at that section on 403b, only 501c3 organizations, schools, and churches. Those are the only three groups that can sponsor a 403b. I should mention that if you run into a governmental entity, and that can be any type of municipality, it could be a governmental hospital, if they have a 401k plan, for that to be accurate, that should have been established prior to May of 1986. And this year I've gotten involved in two plans, two hospital plans that had 401k plans that they established after 1986. So they've had to go through some corrective work to get the appropriate plan types. So you may run across a 401k in a governmental entity. As long as it was established prior to May of 1986, that's okay. If it was done after that, they're going to have to go through some corrective work. 401as, you'll see these a lot with not-for-profit employers and governmental entities. Sometimes that 401a, like Kara mentioned, is in the form of a money purchase plan. And what makes a money purchase plan different than a 401a profit sharing plan is that that money purchase plan has a stated employer contribution. What does that mean? That means that the board of directors has approved it. So please, if you run across a money purchase plan, don't automatically try to take that out, because that's a line item budget item for the employer, and that's an ongoing contribution for those employees. So you find those oftentimes, and I'll show you how some of these plans can work in concert with each other so that you can maximize contributions. But you'll see 401a profit sharing plans and money purchase plans all across all types of entities. Then we get into the two flavors of 457 plans. And there's the governmental 457 plan that is, again, those municipalities, so your cities, your towns, your villages, but also other governmental entities like utility districts and fire districts and or fire protection authorities and hospitals. And they sponsor that governmental 457B. And you will also see those in public schools quite often. And then kind of my final and my favorite, and this is a really good one to pay attention to if you're not familiar with this. This is a Top Hat 457 plan, and this is designed to discriminate. This is purely designed to discriminate. So this gives those key executives, it's limited to a select group of management, and it gives those key executives the opportunity to put in more money, or the employer put in more money for them and only them. So as you're having a conversation with a nonprofit organization, and you'll see that this is available to any 501c organization. So I'll give you an example of a federal credit union that we work with. They simply had, because they are a 501c, but not a 501c3, their main plan was a 401k plan. They wanted to benefit a few more employees. They had never had or heard of this Top Hat 457 plan. and we gave them a way to put in additional money for that select group of management. Guys, really listen to this, because if these nonprofits don't have this, this has been truly the key to us winning business when we are the only one to present this option. We've truly had employers say, no one else brought this solution to us. You brought this solution to us, and therefore we trust that you understand this marketplace. You've won the business, you've been awarded it. So this top hat can be really, really valuable tool for you. And let me kind of show you why all these plans, when you work them together, why you can combine limits and what makes the difference. So when you've got that 401k plan that most of you are familiar with, and I get advisors a little concerned about working with other marketplaces because they're not as familiar with the regulations behind it. Just know that if you work with a 401k plan, you're working with the most complex plan that has the most rules of any plan out there. As you move to the right on the spectrum, there are less rules and more flexibility. So when we compare probably the two most common, when you look at a 401k plan and a 403b plan, the first thing that you're going to see is that top box grayed out, and that's the ADP test. And if you're not familiar with the ADP test looks at the deferrals of your highly compensated employees and compares it to your non-highly compensated employees. And if there's too big of a gap and you fail that non-discrimination testing, that actual deferral percentage testing, then the only way that can be remedied is for your highly compensated employees to get some of their deferral money back, or for the employer to put in additional money to make that test pass. And that almost never happens. That's a really expensive way to correct a non-discrimination test. So if you're working with a 501c3 organization, so remember, any of those charitable organizations, think humane societies, art districts, zoos, any social service type organization, and they have a 401k plan, they've got to undergo that ADP test. And they may only have one or two highly compensated employees, which puts a lot of burden on getting the other people to participate. So if they have a 401k plan, they have to do all of that testing on the left-hand side. But if they would have been set up in a 403b plan, the highly compensated employees could put in up to the maximum, $19,500 for this year, $20,500 for next year. They could put in the maximum deferral and not worry about having any refunds of the money that they put in. Guys, this is huge. This is something that we run into a lot, and fixing that, you've only got a couple of options. You can either freeze the 401k or terminate the 401k. So if you're in a situation like this, you try to come up with better plan design ideas to keep somebody in the 401k, because obviously you don't want to terminate the plan and then have participants have access to their money. But if you're setting up a new plan and you start with the right plan, it makes it a lot easier. Going all the way kind of to the right on this chart, 457B plans, both governmental and top hat, they don't have any of that non-discrimination, nor does a qualified church-controlled organization, which is like a house of worship, a religious organization. So they can absolutely discriminate. So knowing these little nuances when you're having conversations with the decision makers will really help you. And please involve your OneAmerica sales director in these conversations. They should all be fairly conversant in this, but they can also bring in me or someone like Kara or someone else on our practice leadership team to help with these, because these plan design opportunities will really, really set you apart in a conversation from your other peers in the industry. What is that contribution potential? So I mentioned to you that a lot of these plans work in concert with each other. So you have that, let's start with the single plan, the 401k plan, right? Next year, that limit, the total contribution limit for employee and employer contributions is $61,000. Now, you can add, if you're a nonprofit, different types of combinations of plans, and you can increase the contribution potential. If you spend any time in this marketplace, you will learn that most of these employers offer more than one type of plan, especially if they're larger. Overall, it's about 40% of these employers offer 2 or more plans. As you move up market, 1,000 or more employees, that number goes up to about 80%. So you need to understand how these plans can work together and what the benefit of them is. So if you have 2 plans, so we're going to look at that single plan as the first one. Let's say that's a 401k or a 403b. Got 61,000. You add that top hat plan, and that gives you an additional, these are next year's numbers, 20,500. You have now taken the contribution potential up from 61,000 to 81,500. Let's use some real examples with this. So you have a nonprofit organization, either we'll go back to that credit union that I talked about. They're offering a 401k, $61,000 total could be put in between employer and employee. They've got that executive. Now they have the potential for that executive only to put in an additional 20,500. That can be employer money or employee money or a combination of both. Okay, this is big. So you've got people that are making more, able to shelter more tax deferred into that top hat plan. Now let's add a third plan. Let's add an organization that offers a 401, a 403b, and a 457. This mainly is used in healthcare when they are dual status, both governmental and a 501c3 organization, and they're taking advantage of all of the tax codes. I was on a finalist presentation for a hospital this morning, and they had a 401a, 403b, and a 457. So for those that they wish to contribute a lot to an employer money, they could get all the way up to 142,500 next year. This is a big deal, particularly healthcare, where they are looking to attract and retain. I just got back from a healthcare conference last month, and the big thing that is on every hospital's mind is, how do I combat that physician burnout, and how do I attract physicians? How do I attract nurses? But it was mostly focused on the physicians, and none of them were using their retirement plan as a tool for that, because everyone hears retirement plan and they think, oh, the only goal of a retirement plan is to retire someone. But you can really use it to recruit new employees. You can use it to retain employees, and you can use it to reward those really special employees by having the appropriate plan design and using things like the top hat plan, or if you're a governmental entity, by giving a little extra to certain individuals, and you don't have to pass that non-discrimination testing. So this is a deep topic, and I would be happy to have a conversation with anyone offline about it, or Kara could as well when she actually gets her voice back. But do not underestimate the power of plan design for your prospects. So what market sectors do we really talk about? Well, we talk about healthcare organizations, and these can parlay into for-profit organizations as well as nonprofit and governmental. And there's a lot of fluidity around hospitals. One of the things that you'll see more of with hospitals is consolidation. A lot of them divested of some of their long-term care facilities in the past, and they said, we're going to focus on what we're good at. And now they're in a situation where they can't find anywhere to send their patients. So now they're starting to acquire again. So keep your eye on the healthcare market. It's going to change rapidly. And that's why you want to have access to a record keeper that can handle 401, 401k plans, 403bs, 457s, because you could get into a situation where a hospital has one type of plan, acquires another entity, and needs to fold multiple plans together. In the educational market, I would say be very opportunistic in this market. We have a lot of success, and I know we've got a lot of your colleagues that have worked on private education plans with us, and that's a really good marketplace. I would steer clear of the public K-12 market. It's a little bit messier. There's a reluctance to consolidate record keepers, and there's union involvement in that. So I could kind of go on and on why I think public K-12 is probably not the market to focus on, but private K-12, where there tends to be an employer contribution, where there tends to be a single record keeper, is a good market. Higher ed is also a good market up to a certain asset threshold. And for the most part, under 50 million in that marketplace is very underserved. So that's a good focus for you as well in that education arena if you're looking at higher ed and you've got good relationships there. Governmental entities, again, that's an opportunistic market. If you go too big with municipalities, they are all open to those open bidding situations. Where you see good opportunities is those mid-size governmental opportunities where they're willing to bring in an advisor. A lot of these are direct with record keepers today, and a lot of those direct record keepers are cross-selling other products, and that doesn't sit well with most municipalities anymore. So if you're looking in the mid-size space, that's good. And think broad, think, like I said, housing authorities, water districts, any of those utility providers, police, fire. And this is how their mindset can be so linear. I worked with a fire district or a firehouse on a plan that they had, and their comments to me were that they were losing employees to the neighboring fire district, and they said, we're losing them for 50 cents an hour. And this is truly my last in-person presentation. I've done some since, but it was the last one pre-COVID, and they said, we are really tired of losing employees. And then not 5 minutes later, they mentioned the fact that they were giving an 8% employer contribution to all of their employees. And I asked them, are you telling your new employees about this? This was 100% vested immediately money. No, help them look at their plan design and use it to recruit employees, help them use it to retain employees, because there was no reason that fire district should have been losing employees for 50 cents an hour when they were giving people free 8% into their retirement plan. Same thing with the social and community service organizations. Partner with record keepers that can take things off of these employers' plates. COVID has changed a lot for them because they used to get a lot of support from volunteers. And while that's been trickling back in, some of these organizations haven't opened back up and are taking all the volunteers or near as many as they used to. So what are they doing? They're trying to do a whole lot more with less. So partner with record keepers that will take some of that administrative work off of them, because I guarantee you those decision makers that you're talking to have multiple hats. It's like run the retirement plan is low on their list of priorities. They're fundraisers, they're personnel managers, they're on and on and on. So if you can find somebody that can take off things like any of that administrative outsourcing, distributions, help with that payroll integration, you will make a client for life in that marketplace. And then finally, religious organizations. These also have to be choosy because you've got to find the right size religious organization. So some of the best ones, again, kind of dovetail into that private education. But there are church organizations out there, very nice size, particularly those non-denominational churches that are quite large and have a lot of employees out there. Some of them may have been set up with a 401k plan. And this is a pretty technical conversation, but what I will tell you is that if they have a 401k plan, if you run across a religious organization that has a 401k plan, please, please, please involve your OneAmerica representative, because they could have a 403b plan. And I'll go back to the slide up here. If they have a 401k plan and they are a religious organization, they've got all of that non-discrimination testing on the left, but they could have nothing on the right. And what does that mean for a religious organization? It means that if they want to give the pastor a 10% employer contribution and nobody else, they can. It means that if they want to have different levels of matching contributions based on the type of employee, they can. It means that if they have a 403b, they can make contributions for 5 years post someone's retirement. So we see churches that want to retire a minister that's not quite ready to go, take a collection up, and then they put it in the retirement plan, and they put it in over 5 years post someone's severance. The other door opening conversation for religious organizations, talk to them about the minister's housing allowance. Most ministers are very, very familiar with the minister's housing allowance while they're employed. And what the minister's housing allowance allows them to do while they're employed is take part of their gross income, net it out for housing expenses. And I'm talking, it can be utilities, groceries, cleaning supplies. It's a very broad definition, and it reduces their taxable wage base. In a retirement plan, unlike any other tax code, money can go in tax deferred. If they have a housing allowance distribution in retirement, it can come out tax-free. So tax deferred in, tax-free out. And a lot of churches that we come across do not understand this and are not utilizing it. So I think I've covered a lot about places where you can add value. Certainly, you all are the masters on the investment side. You have the relationships for the employee education. And boy, do they need that employee education. For many of them that have had multiple providers in there, they've never gotten a consistent message. And while this group of employees tends to be the most caring, they are so selfless that they don't invest in their own education of their retirement plan. So you can pull us in and partner with us as much as you'd like. We have education consultants that can help you, or if that's a direction that you'd like to take on your own, you are more than welcome to do that. Please, for any record keeper that you work with, partner with somebody that understands those plan design nuances, because they can make the difference between that being a new prospect to a new client for you, really making that transition. And then the administration and compliance. I mentioned at the outset, most of these plans that we come across have issues. Not every record keeper out there understands how to administer these plans and keep them in compliance. Most of our industry is really hardwired to look at things like their 401k plans, which means you might be filing a 5500 when it's unnecessary. It means you might be undergoing an audit when it's unnecessary. So an example of something like that, we worked on a private school in Minnesota. The first call from the advisor came in and said, you know, we've got a private Christian, well, it's Catholic, private Catholic high school, and they're tired of paying their audit fee. They're looking at trying, how can they remove employees and participants from their plan so they can get out of the audit? And the first comment that I made to that advisor was, well, first of all, they're a church plan, so they are non-ERISA. which means they don't have a 5,500 requirement. Therefore, they don't have an audit requirement. So imagine that advisor, when they go back to their client, the first thing that they say to that client is, I can eliminate about $10,000 of your billed expenses every year, plus all of the time that your employees are spending getting information to the auditor. That's how the conversation started. The second part of that conversation came in and they said, oh, by the way, we're failing. We've got a 401k and we're failing non-discrimination testing. And at that point, I said, there is legislation that came out in the end of 2015 called the PATH Act that can convert that 401k over to a 403b without ever having to freeze the 401k, without ever having to terminate the 401k. And by the way, if you do that, and if your client chooses to do that, then they no longer will have to worry about that non-discrimination test failure. How does that sound? It was music to their ears, because what they were trying to do is figure out how to get their part-time coaches out of the plan, because their part-time coaches were causing them to fail, but they wanted to keep them in because a couple of them were participating. And so once they did that, they converted over to a 403b. So then they weren't failing any testing. And oh, by the way, the director of their school, they were able to put in additional money for that person and able to contribute additional money each year until that director is ready to retire. So there is a lot to be said for understanding how the plan can work and operating it correctly. And you can walk in and save them literal thousands of dollars each year. And that's not even touching how antiquated so many of these contracts are. It will not be surprising to me if you run across these opportunities, and even after you add in your fee, you can save them 40 or 50%. So with all of that, there's a pretty compelling story of why to go look at it. Lots of opportunities without advisors, lots of assets in the marketplace. So how do you go about doing it? Well, first, this is really a relationship market. And while I think this market is more open to cold calling than maybe the private sector, it's still better to go in with a warm lead. So we've had some of our advisors who work with the for-profit organization, that person's on the board of a nonprofit. They've gotten lead-ins like that because almost every C-level executive that you know at a for-profit corporation is serving on the board of a nonprofit organization. So that is a great entree into this market. And we even had one where an advisor was presenting to a board, because the decision-making process is, I should mention, a little bit different. With a for-profit organization, you can usually get that answer and that CEO is making the decision. In this instance, it's usually a committee making the recommendation to a board that's approving it. That's not a negative, because we've had advisors pick up 3 plans from for-profit organizations where the board members listen to the pitch to the nonprofit organization. So use it both ways. Use your for-profit clients to help introduce you to nonprofits, and really give it your A game when you're, even if you think you're a shoo-in for that, if you get the opportunity to present to a board, because you may pick up board members off of that. The other way to look at this is just partnering with those local centers of influence. So if you've got ERISA attorneys and CPA firms that you're working with regularly, work in concert. CPAs are thought to be the most trusted relationships that clients ever work with. There was a whole study done on that, and the CPA was the #1 most trusted relationship for employers. But a lot of CPA firms don't have that sales side to them, that outreach side. So you can partner and refer business to each other. The other thing that I will tell you is that many of these organizations are so thinly streamed that they don't have the opportunity to go out and do a due diligence or an RFP. So they rely upon each other for word of mouth and they are extremely loyal in this market. Our average tenure on this side of the house at OneAmerica is 4 times that. It's like 16 years. It's 4 times, I'm sorry, it's more than 16, but it's 4 times that of our for-profit clients. So think about that. They're willing to refer you on, and they're more loyal to you. A couple other prospecting resources. Melissa Data. If you're not familiar with Melissa Data, it's got all kinds of lookups on there. But one of the things that you can do is look up all the nonprofit organizations in your area by putting in a zip code. I think you get 1,000 free downloads a month on Melissa Data. There's also candid.org and 990 Finder, ways to find something called the 990. And the 990, if you're all familiar with a 5500, which is the tax filing for the retirement plan, a 990 is the tax filing for the organization itself. And this is required for almost all nonprofit organizations to complete every year and to keep their tax exempt status. And there's some key sections on the 990. One is the organization's mission. So I mentioned this is a different selling process. One of the things that you should really be familiar with when you walk in to have a meeting with one of these clients or prospects is what their mission is, because everything that they do is in support of that mission. So understanding that, ask them to tell you about it, but you can find financial information. You can find where are their streams of revenue coming from? Are they government grants or other grants? Is it goods and services that they sell or provide? This is just ways for you to find more out about the organization. So pair this with the 5500. But most importantly, and this is not widely known in the industry, so if you've got this little secret, this is a tip for you, is Section 7. And this is so important because everybody who calls on these organizations is going to try to reach the CEO, the director, the CFO, all of those top folks. But in Section 7 of the Form 990, it lists all the board of directors, and it lists anybody that is a key employee that's making over 150,000 or the 5 highest compensated employees within the organization. So most of the time, if you pull up a 990, instead of trying to network into 1 or 2 people, you'll have about a dozen. So leverage your LinkedIn relationships, your local community relationships, and see who you might know out of this 12. Every single call I've ever had where I've had a one-on-one with an advisor and I've said, tell me an organization that you're looking for, that working with, that's pretty prominent in their community. Every time we pull up a 990, someone goes, I had no idea they were on the board. I had no idea they were in that position. I can use that relationship to get in closer. People that you didn't even know were affiliated. A little less known on there, there's also contractors. So if you're working with a lot of contractors in the area, it does list the 5 highest contractors if they're paying them more than $100,000 a year. Again, maybe a different way to get that network into meeting the decision maker. So if you have not seen a 990 before, you want a deeper dive, work with your RSD, work with their internal. They can all pull them up and show you how to find the information, or Kara or I will make ourselves available as well on that. So a couple things about OneAmerica that you may or may not be familiar with. OneAmerica began working with tax-exempt organizations back in 1963. So we have more than 55 years experience in this marketplace. We've seen a lot. We understand it deeply, and all we want to do is be a resource and partner for you in this. We've got unique capabilities that our competitors don't have in the way we report information. So if you recall, I said 40 to all the way up to 80% of these employers offer multiple plans. We can combine those into a single experience that our competitors really can't, which means instead of an employer sending in a payroll contribution for a 403B plan and that top hat 457 plan, 2 separate remittances, they're sending in one. That executive that is getting the statement is getting only one statement that shows all of their assets. And that's big because employees don't care why they have a 401A, a 403B, or a 457. They just care about their retirement plan. And the online experience is the same. Log in one time, you see everything. Make investment changes for you as the advisor. If you're managing the investments, it's one change cascades across all plans. So that's pretty unique in this marketplace. The other thing that we do is we go a lot, I'd say further down market than our competitors, and we offer a lot of customized communication. And we can send out some landing pages if you'd like to take a look at it. But really, OneAmerica, you are our brand. We aren't out there advertising the OneAmerica way. We really want it to be the client-centered focus. So we do a lot of customization that looks at the client's look and feel of that. So this is an example for USA Volleyball. Some of our clients want it to be more lifestyle. Some of them want employees through, that looks like their employee base. Some, like USA Volleyball, want it to really just, shout out their mission on that. So we do all kinds of customization where we will work with the plan sponsor and you to design something that really will resonate with the employer and the employees. So we hope you'll consider us for any future opportunities you have in this marketplace, or start exploring it. Kara and I are always available to you. So if you have any questions, we are happy to answer them at this time.
Yeah, great. Thank you, Jennifer. And as everybody can tell, Jennifer is a wealth of knowledge. I think, well, she's probably seen almost every scenario, between working with healthcare and police departments, fire departments, schools, churches. You can see that she has a lot of background in just helping these plan sponsors get to a better situation. So we're more than happy to help you as you come across the scenario. Andrew, I see you made a comment in the Q&A. We can definitely get you more information on the PATH Act. And the example Jennifer used is a perfect example, right? Where they literally took that church plan and were able to make it go from ERISA to non-ERISA. So they suddenly no longer had to pay the audit fees. But then also through the PATH Act of 2015, they could move it from 401k to 403b. And now they were no longer failing their testing. So there's a lot of great things that can come out of this. You just have to have the technical experts helping you along the way. So Andrew, yes, we'll get the information for you. A couple of other things. If you want additional information, feel free to email Jennifer or myself, or if you'd like to scan the QR code, it will send me an email and I'll be sure that we follow up with you and get you connected to your OneAmerica contact. I think as you work with these type of plans, you're going to come across a lot of different scenarios. You're going to come across plan sponsors that have multiple providers that want to consolidate, plan sponsors that have individual contracts that are going to want to move to a group plan, maybe even plan sponsors that have surrender charges and buyouts. We can help you with all of that. Don't go in it alone. Don't try to tackle it on your own. We can bring the team with you, customize it to your business model, and really help you out. One last thing in closing is that, that example that I used in the beginning with the Head Start, that was actually a referral from a CPA firm. For whatever reason, that advisor, that advisor hadn't contacted the plan sponsor in 2 to 3 years. So probably wasn't engaging with that CPA firm as well. But there's great opportunities and relationships. If you are looking to get your foot in the door with, say, an employee benefit shop or a CPA firm, this is an example of a presentation that we could do to employee benefit shop and offer insurance CE, right? Everybody likes their CE credit. So we can partner with you. Same with the CPA firms. Everybody likes their CPE credits. So we could do a similar presentation, just like what Jennifer did, and offer everybody in that accounting firm 1 hour of CPE credit. It's a way to get them their CE credits, educate them on this market that they work with from the tax side or the employee benefit side, but then also, ideally, hopefully, they'll go to you the next time they have an opportunity, and that plan sponsor goes to their accountant or employee benefits and says, hey, I really need help with my retirement plan. They'll say, wait a minute, I'm partnering with that advisor. They recently did a presentation. I'm going to reach out to them first. So there's a lot of different avenues and ways that we can work with you to grow those relationships with those outside centers of influence. So Jennifer, I want to thank you again for filling in today. Actually, she's a great resource, and chances are if you have a scenario, she'll be one of the folks that you'll be talking to kind of figure out what those details are. And Leah, I just want to thank you and all the members at RPAG as well. It's been so great to, again, be in person with so many of you this fall, and hopefully this spring we can kind of follow suit and be back in person again. So thank you, everybody. Have a happy and safe holidays, and we will see you next year.